It shouldn't be about comparison with peers, but it is. Were commodities the problem here? Because Goldman stuck by commodities and had a terrible quarter. Morgan Stanley started to divest its commodities units back a while.
Yeah, I think commodities was probably one of the areas for Goldman that was more challenged, and so they're disproportionately levered there, and so that was probably one of the points. The other point is just in kind of client mix. Goldman Sachs tends to be a little bit more levered to institutional money managers. Some of the other banks are a little bit more levered to corporations, and so in this backdrop that we're in, where volatility is low, asset prices are at highs, institutional money managers are largely sitting on your hands, and so in that environment, trading can be really tough, especially when that's the majority of your clientele.
Across the banks, why were net interest margins, net interest income so disappointing for the most part?
Yeah, I think there's a couple things. We saw securities yields actually come down a little bit in the quarter, and so the long end of the curve came under some pressure. On the front end of the curve, we saw rates move up, and that was a positive. And the other point is that we're seeing really good deposit betas, which are essentially the percentage that companies are passing through to their clients. So I think we actually are seeing a nice uplift in net interest income for a number of companies. Some of it's going to come in on a lag, so you just didn't see it all this quarter. But I think going forward, you'll continue to see the net interest income moving up for a number of the banks.
Yeah, Devin, on that note, I've just got the 2s 30s curve here. Of course, you'll be really familiar with this. The trend has been for flattening here. Who is this good for? Who is it bad for out of the financials that you cover?
Yeah, I think that a number of banks have really positioned their interest rate sensitivity where they're shorter in duration, which means they're going to benefit more from the move in the front end of the curve, which is the Fed funds rate. Longer term, I don't think banks like to see a flattening yield curve because it's just more difficult to make money. So I'd say they're all in a fine spot for now, but if the yield curve continues to flatten, that will become a more difficult environment. So something we're keeping obviously a close eye on. I think the net interest income story for a number of banks is still very positive. It's been a big driver of the shares, and I think it's something that will continue to support further appreciation. But clearly, we're going to keep an eye on kind of where the yield curve is moving to.